A tenant who rents for 30 years and a landlord who owns for 30 years both make monthly housing payments for the same period. At the end of 30 years, the tenant has a housing expense history. The landlord has a paid-off asset worth multiple times what they originally paid. Every month of rent the tenant paid contributed to that outcome, just not for the tenant. Here is the calculation most renters have never done. Take your current monthly rent, multiply it by 12. Now multiply that by how many years you have been renting. Look at that number. That is how much you have paid toward housing costs that generated zero ownership stake for you. Now ask where that money went. In most cases, it went toward a landlord's mortgage payment, which means your rent payment was doing two things simultaneously. It was covering your housing cost, and it was paying down the debt on an asset you will never own. Every month, for every year you rented. Most people understand intuitively that renting does not build equity. What most people do not fully understand is the specific mechanics of how a landlord's wealth builds on the other side of that transaction. How the tax code treats rental income differently from wage income. How depreciation allows a landlord to legally reduce their taxable income on a property that may be rising in market value simultaneously. How leverage amplifies returns for property owners in ways not available to tenants. By the end of this video, you will understand the full mechanics of how property ownership builds wealth and what that understanding changes about your own financial decisions. Let us start with what your rent payment actually does. Let us walk through the mechanics of how a landlord builds wealth from a rental property. Say a landlord purchases a property for $300,000. They put down 20%, $60,000 of their own money. They finance the remaining $240,000 at a fixed interest rate over 30 years. Their monthly mortgage payment is approximately $1,600. They rent the property to a tenant for $2,000 per month. Here is what happens every month. The tenant pays $2,000. The landlord forwards approximately $1,600 to the bank as the mortgage payment. The remaining $400 is the gross cash flow before maintenance, insurance, property tax, and vacancy costs. Now here is the part that does not appear on the monthly statement. Every mortgage payment is split between interest and principal repayment. In the early years of a mortgage, the majority of the payment is interest, but a portion, even in year one, goes toward reducing the outstanding loan balance. That principal repayment is effectively the tenant's rent payment being converted into the landlord's equity. Over 30 years, as the mortgage is paid down using primarily the tenant's rent, the landlord's equity in the property grows from $60,000 to the full property value. Now add property appreciation. Historical data on residential property values in developed economies shows average annual appreciation of 3 to 4% over long time horizons. On a property originally worth $300,000, at 4% annual appreciation over 30 years, the property could be worth approximately $970,000. The landlord invested $60,000 of their own money. The tenant's rent payments covered most of the mortgage. The property is now worth nearly $1 million. That is the leverage effect of property ownership. A $60,000 investment controlling a $300,000 asset that appreciates on its full value, not just on the down payment. The tenant provided the income stream that made the investment self-funding and received nothing from the appreciation that their rent payments helped produce. Now let us talk about the part of landlord wealth building that almost nobody discusses when comparing renting to owning: the tax treatment of rental property. Because the wealth gap between landlords and tenants is not just about equity and appreciation. It is also significantly about what the tax code specifically does for property owners. Advantages that are entirely invisible to the tenant paying the rent that funds them. Start with depreciation. When a landlord owns a rental property, the tax code allows them to deduct the cost of the building, not the land, over a period of 27.5 years. This is called depreciation. And here is what makes it remarkable. The landlord deducts a portion of the property's value from their taxable income every year, even if the property is actually rising in market value. A property worth $250,000 in structure value generates approximately $9,000 in annual depreciation deduction, which reduces the landlord's taxable income by $9,000, regardless of whether the property went up or down in value that year. This means a landlord can collect positive cash flow from rent watch the property appreciate in value, and simultaneously report a tax loss, because the depreciation deduction can offset the rental income on paper. This is entirely legal. It is written into the tax code, and it is available only to people who own the property, not to the tenant whose rent is funding the cash flow. Second, mortgage interest deduction. For investment properties, the mortgage interest paid to the bank is fully deductible as a business expense. In the early years of a mortgage, when most of the payment is interest, the majority of the landlord's largest expense is tax deductible. Third, property tax deduction. Property taxes paid on a rental property are deductible as a business expense. Maintenance and repair costs are deductible. Insurance is deductible. Property management fees are deductible. The landlord's entire operating cost structure is deductible against the rental income they earn. The tenant has no equivalent deductions. Their rent payment is made with after-tax income. They receive no deduction for the largest monthly expense in their budget. Fourth, capital gains treatment on sale. When the landlord eventually sells the property, after years of appreciation, the gain is taxed at the long-term capital gains rate, which is lower than the ordinary income rate that taxes the tenant's wages. And through a provision called a 1031 exchange, available only in the United States tax code for investment properties, the landlord can roll the gains from one property into a new investment property and defer the capital gains tax indefinitely. A landlord who uses this provision correctly can grow a property portfolio over decades without ever paying capital gains tax, continually rolling appreciation forward into larger and larger assets. This provision does not exist for tenants. It does not exist for wage earners selling their primary residence at comparable scale. It exists specifically for investment property owners. The tax code does not treat housing as just a place to live. It treats ownership of housing as a privileged category of wealth-building activity and structures its advantages accordingly. The tenant experiences none of them. The landlord collects all of them, using the tenant's rent payments as the primary income source. If understanding the tax advantages of property ownership just changed how you see your monthly rent payment, stay with me, because the equity mechanics and the tax advantages are only two of the three forces widening the gap between landlords and tenants. The third force, and the one that operates most automatically, is what comes next, and it compounds, whether anyone is paying attention or not. Here is the third force: inflation and monetary expansion, which we have covered in detail in previous videos. On this channel, treat property owners and tenants completely differently. When the money supply expands and purchasing power declines, the nominal price of property rises. The landlord's asset is worth more in nominal terms. Their fixed-rate mortgage debt, if they have one, is being repaid in dollars that are worth less than the dollars originally borrowed. This is the borrower's advantage from inflation that we have discussed before. But for property owners, it goes further. Their asset rises in value. Their debt shrinks in real terms, and their rent, which they can adjust upward as inflation erodes purchasing power, grows with the inflationary environment. The tenant experiences inflation only on the cost side. Their rent rises. Their wages may or may not keep pace with inflation. Their ability to save toward a down payment, already challenged by the gap between wages and cost of living, we covered in that video, is further compressed by rising rents consuming a larger share of their income. The gap compounds in a specific and cruel way. Rising property values make the entry point for ownership higher. Rising rents reduce the surplus available to save toward that entry point. The tenant runs faster to stay in the same place relative to the entry point that keeps moving away from them. And here is the institutional dimension of this dynamic that has emerged more prominently. In recent decades, large institutional investors, investment funds, private equity firms, and real estate investment trusts have increasingly entered the single-family residential market that was previously dominated by individual landlords. These institutions purchase residential properties at scale, often outbidding individual buyers with cash offers and converting those properties into rental units. In some markets, institutional buyers have accounted for a significant share of residential property purchases, contributing to reduced supply of homes available for individual purchase and upward pressure on both property values and rents simultaneously. The individual tenant competing to buy in those markets is not just competing against other individual buyers. They are competing against institutions with access to capital at a scale no individual can match. Institutions that benefit from every tax advantage we discussed at dramatically larger scale. The mechanics that favor individual landlords over individual tenants are the same mechanics that favor institutional property investors over everyone else, just amplified by scale and by access to capital that individual savers simply cannot replicate. Here is what understanding the landlord-tenant wealth gap actually changes. First, it reframes the rent versus buy question entirely. The question is not whether renting is throwing money away. It is whether the specific numbers in your specific market and financial situation make ownership feasible and financially superior to renting and investing. The difference. We covered that calculation in full detail in our video on why your house is not the investment you think it is. What this video adds to that calculation is the tax dimension and the leverage dimension. If you are renting and investing a meaningful monthly surplus into index funds, you are partially accessing the wealth-building mechanics available to asset owners. Not identically, index funds do not offer depreciation deductions or 1031 exchanges, but the underlying compounding principle, deploying capital into assets that generate returns over time, is available. Second, if ownership is on your horizon, understanding these mechanics changes what you optimize for. You are not just buying a place to live. You are acquiring an asset that comes with a specific tax treatment, a leverage structure, and a 30-year equity building timeline that operates whether or not you are paying conscious attention to it. Understanding that changes how you evaluate the size of the down payment, the fixed versus variable rate decision, and the hold period that determines whether the investment mechanics actually work in your favor. Third, understanding institutional property investment explains why housing affordability has declined in specific markets faster than income growth would predict. That is not bad policy execution. It is a predictable outcome of giving institutional capital access to the same residential market that individuals use for housing. When institutions and individuals compete for the same housing supply, the party with cheaper and more abundant capital wins more of it. That is the market working as designed. Understanding it is the first step toward making decisions that account for the real terrain. Every month of rent you pay is building someone's wealth. That is not inherently unjust. Property ownership requires capital, risk, and responsibility that renting does not. But the specific tax advantages, the leverage mechanics, and the institutional dynamics that widen the wealth gap between owners and tenants were not designed by the housing market. They were written into the tax code and the financial system by people whose interests aligned with property ownership. Now you understand exactly how those mechanics work. Share this with one person who has ever felt like they are falling behind financially despite paying their rent on time every month. And if you want to keep understanding the wealth gaps nobody explains clearly, subscribe to Hidden Truth Files. Hidden no more.